$14 billion in cargo is missing. The port of Los Angeles is hemorrhaging shipments. And China didn't blink, just pulled out. Trump's tariff gamble triggered a collapse in U.S. trade flows so fast retailers are counting weeks until shelves run dry and contracts implode. This isn't speculation. It's happening right now. Overnight, $14 billion in cargo was erased from America's inbound supply chain, and it wasn't caused by a natural disaster strike or cyber attack. It was triggered by a single economic decision. President Trump's tariff escalation on April 2nd, raising duties on Chinese goods to 145%, set off a reaction from Beijing that effectively severed the artery feeding nearly half of the Port of Los Angeles's traffic. Gene Sirica, the port's executive director, told CNBC that next week's cargo volume is projected to fall just a little bit over 35% year-over-year, citing real-time data from their Asia-based port optimizer system. That projected shortfall represents a collapse in merchandise valued at roughly $10 billion, according to Reuters. Sirica didn't speculate. He stated plainly that major U.S. retailers have already stopped all shipments from China. But if the goods aren't coming in, what happens next at home? The logic behind the tariff hike was pressure forced China back to the table. But the observable result, at least so far, is silence from Beijing and escalating financial strain on American importers. According to shipping data reviewed by Bloomberg, outbound vessels from Chinese ports to the U.S. West Coast have fallen 40% since early April. That drop includes approximately 320,000 containers, many of which were previously booked and are now stuck at origin. Cancellations aren't theoretical, they're already reshaping the freight map. Hapag-Lloyd, one of the largest container carriers, globally confirmed that it has seen about 30% of its China to U.S. bookings canceled in just 1 week. So was this tariff meant to trigger negotiations, or has it triggered something closer to a logistical lockdown? Ask Jim Gerson. Jim Gerson runs the Gerson's Companies, a third-generation supplier of seasonal goods that services America's biggest retailers. Based in Olathe, Kansas, Gerson's business depends on China for more than half its inventory. Right now, 250 of his containers are stuck, products valued in the tens of millions according to the company's $100 million annual sales figure. The clock is absolutely ticking, he told reporters. For companies like his, there's an arrow window each year to ship Halloween, Thanksgiving, and Christmas inventory across the Pacific. Miss it, and the goods don't just arrive late, they become worthless. This isn't just a cash flow issue, it's a calendar crisis. But how many companies are operating on that same tightrope, and how soon before they fall? Sirica estimates retailers have 5 to 7 weeks of inventory left before the slowdown becomes visible to consumers. But it won't start with empty shelves. It will start with missing variety. You'll start seeing less choice, Sirica warned, using the example of looking for a blue shirt and finding only 11 purple ones and 1 blue in the wrong size. That's not a minor inconvenience. It's the tip of a larger disruption. And the impact won't be confined to apparel. Retailers like Walmart and Target have already alerted the Trump administration that shoppers could face higher prices and limited selection by mid-May. According to a Bloomberg survey, U.S. imports are now forecasted to decline at a 7% annualized rate for the second quarter of 2025, the sharpest drop since COVID. So what happens when the back-to-school season arrives and the warehouses are still waiting? Jay Foreman, CEO of Basic Fun, a toy supplier that generates $200 million annually and relies on China for 90% of its inventory, didn't hedge his words. He called the current tariff freeze a de facto embargo. For now, his customers are holding orders, but if the tariffs remain at this level, he expects cancellations. This is the early phase where the impact is still manageable, but each passing week increases the financial pressure. His warning. There's a couple weeks then it really starts to hurt. The damage isn't speculative, it's accelerating. According to tracking compiled by Bloomberg, China to U.S. container volume has dropped by about a third since early April. But the question isn't whether shipments have slowed, it's whether they'll restart in time to salvage the peak retail calendar. Even if tariffs are lifted tomorrow, the freight system might not be able to snap back. Lars Jensen, CEO of Vespucci Maritime, warns that reopening trade flows after a hard stop doesn't restore normalcy. It creates bottlenecks. Ports are designed for stable flows. Not the off-again, on-again volume shifts, Jensen explained. During COVID, similar disruptions sent container prices soaring and left goods stranded for weeks offshore. That cycle could repeat, but with one critical difference. This freeze isn't caused by labor shortages or global health protocols. It's triggered by government policy, and the longer the standoff lasts, the greater the backlog when it ends. But if companies can't count on political stability in trade, will they keep betting on the same routes? While retailers brace for price hikes and consumers prepare for leaner choices, the freight sector is already feeling the hit. April saw 80 canceled sailings from China to the United States, up 60% from the worst months of the pandemic, according to veteran shipping analyst John McCown. This is no longer just a trade dispute. It's a hemorrhage. Judah Levine, head of research at Freightos, said carriers are now slashing capacity to prevent freight rates from cratering. The strategy may shield pricing temporarily, but it comes at a cost: fewer jobs, idle vessels, and mothballed routes. And while some companies are pivoting to Southeast Asia, the infrastructure there isn't ready to absorb China's volume overnight. As Bloomberg's latest shipping data shows, the shift is real, but uneven and incomplete. So if the US-China corridor remains frozen, can the freight industry survive on fragments? When ports stall, it's not just retailers losing profits, it's workers losing paychecks. The slowdown triggered by Trump's April tariff hike is already bleeding into the broader labor market. According to Torsten Slock, chief economist at Apollo Global Management, reduced Chinese imports could set off COVID-like disruptions with layoffs, first hitting trucking, logistics, and retail. The World Trade Organization forecasts up to an 80% drop in goods traded between the United States and China under current conditions. Meanwhile, Bloomberg's latest projections show U.S. imports are expected to fall at a 7% annualized rate in Q2, the sharpest contraction since early 2020. While Treasury Secretary Scott Bessent calls the situation unsustainable, there's still no deal in sight. This isn't just a container issue, it's a chain reaction across the working economy. But if this freeze becomes the new normal, what does that mean for inflation and for consumer trust? Let's step back, because this isn't theoretical anymore. Job cuts are on the table, prices are already climbing, inventories are draining, and as the holiday buying season approaches, businesses are running out of time and options. So here's the question. If the US-China standoff holds through summer, who pays the bigger price, Beijing or Main Street America? Drop your take in the comments. The next numbers might force a rethink. US importers are scrambling to reroute orders through Southeast Asia, but scale is the limiting factor. According to Hapag-Lloyd, cancellations from China are up 30%, while demand from Cambodia, Thailand, and Vietnam is rising sharply, but not nearly enough to absorb the shortfall. China shipped $439 billion worth of goods to the U.S. in 2024, according to Census Bureau data. Replacing that with fragmented regional suppliers is neither fast nor efficient. Judah Levine at Freightos warns of a whiplash effect if a sudden rebound follows this slowdown, pointing to overloaded ports and inflated freight rates similar to the post-COVID chaos. And Southeast Asia lacks the infrastructure to move massive volumes at scale without delays or quality compromise. So are these alternatives really strategic shifts, or are they emergency stopgaps waiting to crack for U.S. retailers? This isn't just about where goods come from. It's about when they get here. March through May is the shipping window for back-to-school and holiday merchandise. Miss that and shelves stay empty through Q4. Jay Foreman, CEO of toy manufacturer Basic Fun, says his company is entering a critical stretch. We're in a period where the damage is manageable, but every week the damage level is going to increase. His firm sources 90% of products from China and sells to Walmart and Amazon. If the blockade continues, he expects cancellations to spike by mid-May. Historical data from past supply chain disruptions shows that even short delays ripple for months, and the current standoff is approaching its fourth week with no resolution in sight. But if the shipping lanes don't reopen soon, how many retailers will miss the year's biggest profit window? The 145% tariff hike was pitched as a pressure tactic, but 4 weeks in the data suggests it may be producing more domestic friction than international compliance. There's been no public progress in US-China negotiations since the tariffs were imposed. Soroka confirmed on CNBC that container volume from China remains very light at best, with May bookings down sharply. Treasury Secretary Besson's warning hasn't changed. White House policy and import-dependent industries are still bracing for deeper hits. While it's possible that Beijing is waiting for the U.S. to blink first, there's no indication of urgency from either side. In past trade standoffs, prolonged impasses led to permanent rerouting of supply chains, diverting billions in long-term contracts to countries outside the conflict. Is Washington risking the loss of its most valuable trade pipeline in the name of short-term leverage? For manufacturers, shippers, and retailers, the damage extends beyond balance sheets. What's breaking now is predictability. Even during COVID, the chaos was unintentional. This time, it's policy-driven. Lars Jensen of Vespucci Maritime warns that restarting after a shutdown doesn't return operations to normal. It creates instability. Markets are designed for stable flows, he said, not the off-again, on-again volume shifts that policy-induced volatility creates. During the pandemic, container rates from Asia to the U.S. quadrupled. If the current freeze flips into a surge, expect similar price distortions again without the excuse of force majeure. Businesses reliant on steady timelines are being forced to accept strategic uncertainty as a new default. But what happens when trade becomes a coin toss? If you think this $14 billion shutdown is the whole story, think again. Because this tariff war isn't just about containers and contracts. It's about currency capital and long-term economic dominance. China hasn't exhausted its options, and neither has the U.S. But while policymakers posture, the freight lines are freezing, businesses are bleeding, and consumers are already paying more for less. And if this continues, the next blow might not be cargo. It could be a $500 billion treasury dump, a credit freeze, or the dollar losing its crown. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.